The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, joining us now for a conversation as we take a broad look at the ag economy and the markets, David Widmar with Agricultural Economic Insights is back with us. David, it is good to hear from you again. Hope you had a great 4th of July holiday. Thanks for joining us on the show.
Yeah, Jesse, great to connect. Thanks for having me on.
Well, let's just start broadly. I know a lot of producers, they're looking hard at these markets. They're not loving the price action as of late. That's in one bucket. In the other bucket, we have, of course, just the general ag economy and the feelings surrounding interest rates and so much more with farm loans and liquidity and just the broader economy in general. And that might be a good jumping off point for us here to start today. Midsummer, as you take a look at where things stand with the economy, interest rates, and more, you guys have been working on this a little bit. What stands out to you right now, David?
Well, I don't think there is a summer in recent memory that has had more uncertainty. So we always have the growing season uncertainty. So we'll put that as sort of a neutral. We also have this trade uncertainty, and I think that's going to be highlighted this week as we see these sort of the letter of the deal conversation coming out of the White House. Maybe some of these tariffs are going to boomerang back up to levels that were really high that we talked about back at Liberation Day. And I think there's also this macroeconomic uncertainty. There's the question of how are tariffs going to impact commercial or consumer level prices, and of course interest rates. You know, the Fed said recently that we would already have lower interest rates if it wasn't for this tariff uncertainty. And so the question is starting to be, how is this going to work its way into the farm economy? So economists are pretty good at thinking how one of these changes might work their way through the system, but we just have supply, demand, macro, micro, all sorts of levers going in all sorts of different directions. It's really hard for decision makers, especially producers who are in the thick of this, to navigate all this. And we didn't even talk about ad hoc government payments, which could or could not come forth based on how trade and production and prices all sort themselves out.
I want to talk more trade, production, exports, et cetera, here in a minute. In terms of just interest rates in general, there's been a lot made about how the Fed hasn't lowered their interest rates. They kept things steady. What is AEI seeing on the horizon? What's the forecast moving forward? Could we see any change to interest rate policy that could have an impact on the farm, David?
Well, that's a really great question. I think the Fed has been saying, or the Fed did say at its June meeting, that they think maybe 2 cuts are possible in this calendar year still. So 2 cuts would equal 50 basis points coming off the Fed funds rates. I think if you were to look at that really closely, there are a group of FOMC participants who said no changes, and there's another group that said 2 cuts. And so the median between those two was 2 cuts, but it's up in the air even amongst the Federal Reserve participants how that's going to play out. But one of the things we've been talking to the producers about is that the Fed funds rates from sort of trough to peak went up about 550 basis points a couple of years ago. And farm level interest rates went up about 350 basis points. And so the good news here is that farm rates didn't increase as much as we would have initially expected. If you had told me back in 2022, the Fed funds rates were going to go up 550 basis points, I might have expected a similar amount. I wouldn't have expected only 350 basis points of hikes. So the implications today are that farm level interest rates are cheaper than what we might have initially thought given where Fed funds rates. And so the takeaway here is that as the Fed lowers those Fed funds rates, we might not see as much movement or improvement in farm level interest rates. And so I don't encourage producers to build a business plan or a financing plan that's reliant on a big downward change in interest rates at the farm level. I think there's uncertainty at the Federal Reserve level, and there's uncertainty as to how those changes in the Fed funds would work their way in the farm level interest rates.
Well, and of course, with everything going on in farm country, we are watching the trade picture and demand. I mean, we see prices in the markets are down at low levels that not a lot of producers like, and that's certainly not helping the farm economy and all this uncertainty surrounding trade. I know you guys just posted an article on the AEI.ag website talking about who's buying U.S. corn? Who's buying these exports of U.S. corn? Demand, at least on the corn side, has been fairly good as of late. Talk about this, David. What are you guys seeing right now?
Yeah, I echo your point about there's been a strong improvement in corn exports. I think that's how we got away from this 15% stocks to use conversation we've been having 18 months ago. Exports have been picking up. Exports have been a roller coaster for the last 5 or 6 years. Let's just step back, and from 2020 to 2022, exports fell about 40%. So that was a big adjustment, and we've managed to crawl most of our way back out of that hole. Most of that export contraction was China leaving, and China hasn't came back. So who's buying this corn if China left? And in fact, China's actually bought 100 million bushels less corn for this current marketing year than they did at the same pace a year ago. So they're still cutting back on their purchases. When we looked at the data, we saw Mexico bought a lot of corn last year, a really big increase coming out of Mexico. And when we look at activity to date for this 24-25 marketing year, there's a lot of countries that are buying a little bit more. So we often get excited about headlines in agriculture about one big country like China buying a lot more corn. But we can also get relative big changes from a lot of small partners. And that's what we've seen. South Korea has bought 114 million additional bushels of corn this marketing year compared to where we were at this time last marketing year. Spain, I think, and Vietnam stand out because they have bought 80 million bushels and 41 million bushels respectively, but they bought almost nothing on the previous marketing year. So we're adding new trade partners. We're adding big increases on trade partners who bought very, very little just a year ago. And so it is a lot of activity from us. It's a little bit of an increasing from a lot of individual trade partners. And that's hard to summarize. That's hard to capture in a headline. And I think that's part of the uptick that we've seen is, I think one of the quotes we had in this article was that there are 17 additional countries that bought corn during this marketing year that didn't buy corn in the previous marketing year. And that's really been a really big increase and a really big boom.
I think something that ties these two things together in our conversation here today as we think about interest rates and then exports, you've been doing work on exchange rates. Talk to us about this a little bit, David.
Yes, that is a really great connection between those two important topics. Exchange rates are easy for us in the United States to overlook unless we're going on a vacation somewhere. But exchange rates are the first prices that our international buyers have to think about. They have to take their local currency, buy U.S. dollars, and with those U.S. dollars, then buy the bushels of corn or soybeans or bales of cotton that they're interested in. And so one of the things to really keep in mind and to think about is that where have ag exports, where have the exchange rates gone? And we took a look at this a couple different ways. The first way we looked at this is U.S. exchange rates sort of broadly across the whole economy. This is one we see the most. And the first thing to point out is there's a difference between our exchange rates compared to advanced economies like the EU versus emerging economies like South America or Southeast Asia, for example. And so we really have to keep a split screen as to what's going on with the exchange rates. The other thing that we really also focused on is taking corn futures prices and soybean futures prices and saying, if we converted what we see on the Board of Trade to a local currency, say the Mexican peso, for example, how has those prices changed over time? So what we see going back to December 2024, we're looking at December 25 futures prices. And so we know that prices are a little bit better today on the board than they were back in December for this new crop contract. But if you look at that dollar value in pesos, for example, it actually takes fewer pesos to buy a bushel of corn today than it did back in almost a year or 7 months ago. And the idea here is that it's becoming more affordable for our international buyers to be buying these bushels of corn and these trainloads of corn because this exchange rate's offsetting some of that higher farm gate prices being offset by that exchange rate. We'll see how this plays out and moves out. It hasn't been a huge pendulum swing yet, but it's starting to set this deck here. A weak dollar is often seen as a not a good sign for the economy, but the other way of thinking about this is a cheap dollar, it makes it easier for us to export agricultural goods and services.
AEI.ag. I know folks can head to your guys' website, David, to find a lot of the research and so much more that you guys do, whether it be the free side or the premium side, right, David?
Yeah, we have a lot of great tools and reports and insights that we try to share. There's a free weekly insights newsletter that includes an article, and that corn export buying was one that we featured. But we're also keeping our pulse on what's going on in ag trends when it comes to the farm economy, and we're trying to help decision makers navigate all that uncertainty out there.
David, any other final thoughts you would have for us here as we wrap up our conversation today?
One thing that we've been keeping our eye on is the length of farm loan maturities. And so this is for farm loans and equipment. When interest rates were really low, we saw really long payment periods. And you think about this for a car loan, right? How long those car loans get stretched out. Well, we've also seen a contraction of these farm machinery and equipment loans. We wrote about this. We were over 50 months around 2020, and now it's fallen below 30 months is the average repayment period. That's the lowest and shortest repayment period that we've seen in more than a decade. And I think the implications is that producers are looking at this and they're saying, hey, one way that I can reduce my interest expense is just not have that debt out there as long, so I'll shorten that up. But the other side of that coin is that it's creating a higher annual debt service cost. And so we have shorter repayment periods, means we're making more principal payment per year, and that's really going to increase that cost and make it more challenging on a cash flow standpoint.
AEI.ag for more information. David Widmar, Agricultural Economic Insights. Thanks for joining us on the show. Appreciate the time.
Thanks, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.